Howdy, hotshots. It's the Dividend Daddy, your favorite, not a financial advisor with not financial advice. A little tumultuous in the market today, but ULTY was holding its own. Last I checked, I think it was up like half a cent. Perfectly fine. Actually, really great for the red that I saw in parts of my account today. Things were really rocky, like SCHD was up, but then VOOG was down. ULTY was up a little bit, but I had SPY down and QQQI was down just a touch, I think. I can't even remember. It was such a shotgun approach to what was red and what was green in the account. But we've talked before about how ULTY operates, okay? What makes shares go up? What makes shares go down? But we have a lot of new viewers, and we have people in the comments that still seem to not quite understand. They think that I sell shares and it drives the price down, or I talk to 100 people and they buy shares and it makes the price go up. That's not what's happening. And so I want to explain it for those who don't quite understand it, who think it's going to behave like an individual stock. The way an open-end ETF works, like ULTY. ULTY is an open-end ETF. Money flows into the fund, and they give that money to an authorized participant, or an AP. That authorized participant goes out into the market and buys the shares of the stock that make up the share of the ETF. So if they have Nebius, and they have Tesla, and they have Rigetti Computing, or whatever they have at the time, the authorized participant uses the money that the fund manager, YieldMax, gives them, and they go out into the market and they buy shares of all those companies, and they give them back to YieldMax to create more shares of ULTY. So the outstanding share count for ULTY is going to go up and it's going to go down depending on whether there were inflows or outflows that day. If a bunch of people go in and sell ULTY, then ULTY takes those shares and gives them to the authorized participant. The authorized participant goes and liquidates all the assets and gives the money back to ULTY to pay out the shareholders that sold their funds. Now, obviously, there's going to be some slippage and there's going to be some immediate market reactions that don't fully account for that time period that it takes to do that. Okay, so what you'll see is that open-end ETFs, not quite as drastically as closed-end ETFs because they have a set number of shares unless they do a share offering, but open-end ETFs will trade at discount or premium to NAV. NAV is created by all of the funds that are in the account, divided by the number of shares. So your shares NAV would be your portion of all of the stocks and options holdings and cash or SGov, wherever they have the money sitting, all of that combine up and then divide down by the number of shares, and your little piece of each of those in your share is what makes your NAV. All right, that's your NAV, your net asset value. That is what determines the price of your shares, okay? Like I said, it can move a little bit because it can trade at a premium or a discount to the NAV, but we're talking about, you know, on ULTY, I've only seen like plus or minus 0.2%. 0.2%. So 2% on, $6 would be 12 cents. So 0.2% is going to be 1.2 cents. Okay, so there's some whale, it's not like a crypto, right? It's not like there's some whale out there that is buying up ULTY and driving the price up, or shorting ULTY and driving the price down, or whatever. Okay, they're not doing that. Now, what could happen, because the fund is very big, okay? It's got a lot of money in it. What could happen is that with all of the inflows that come in, they could go out and buy the shares of the stocks that they hold and drive the price of the shares up, the underlying shares, probably in a short term, because it's not quite enough money to move the whole market. But, if they're buying a somewhat smaller end of the companies that they buy, they might be able to move the shares a little bit temporarily. But it's not, people going and buying ULTY are not causing the price of ULTY to go up. And people that are selling it are not causing it to go down. What causes it to go down, okay, is when they lose money on their options, or when they pay out their distribution, because that cash comes directly out of the total NAV of the fund. I'm not saying that they are selling the shares to give you that money, but it's coming out of the value of the fund. Or when the share prices of the stocks that they have go down. That's what causes ULTY to go down. Now, what keeps ULTY from going up quickly is the strategy. It's a covered call fund. So what that means is that you participate in losses in the stocks, but your upside is capped. So any of those stocks that go just screaming up, you're not going to realize the full gain on that stock, because once it crosses the strike price of the option and it becomes in the money on our short covered calls, you're no longer getting any gains, okay? If you have a stock that is $50 and you sell a covered call at $55, that stock could go to $20,000 and you're still only going to get the premium that you made selling the covered call and the $5 gain from the $50 current stock price to the $55 covered call strike price, because that option is either going to have to get bought out at a loss, or it is going to get exercised and they're going to have to deliver those shares to the option buyer, because the option buyer has the rights. So that is why covered call funds in general do not participate in all of the gains of their underlying asset. Now, ULTY buys puts. They buy puts for security, for downside protection. They're quite a ways away. They're out of the money because it's too expensive to buy them right at the money or in the money or just out of the money. So they're quite a ways out of the money. Now that means if one of these companies went bankrupt overnight and ULTY happened to own protective puts on that share, you would only lose the value from the current price of the stock down to the strike price of the put. Because in this case, ULTY is the buyer of the put, and they have all the rights. Okay, so if you have a $50 stock, going back to the $50 stock, and they have a $40 put on that stock, if that stock goes from $50 to $0, you're going to lose the difference between $50 at the current stock price and the $40 strike of the put. Okay, so you're going to lose that $10. Plus that put is now going to expire, or we exercised it or sold it out to get that $10. So you're losing the premium that you paid for the put too. Okay. Now, as far as distributions, another thing that causes ULTY to continuously go down is if they do not earn enough in a week to pay out their distribution. So if they only earn 8 cents, but they pay out a 9-cent distribution, that 1 cent has to come from somewhere. It's going to come from options sales, or it's going, like they own the puts and they sell them and recoup that money, or it's going to come from stocks that they've sold off, or something. That 1 cent has to come from somewhere. So if they are paying out a higher yield or a higher distribution than the money that they are earning each week, that will also cause your share price to go down. Okay. And then of course that money's not there to grow back to what it was. So, at that point it would obviously not recover that 1 cent. Now the rest of the NAV that it has, the rest of the stocks could go up and make that. But this is why ULTY can go down faster than it can go up. It doesn't mean that it can't go up. Okay. It holds very volatile stocks. We need that volatility in order to generate huge option premiums, and that's how they get the big distribution. So you have to have highly volatile stocks. Highly volatile stocks go up and down very quickly, okay? Now, obviously, we hope the fund managers are doing a good job and picking stocks that are more likely to go up, but sometimes you get a string of them that go down. Now, because the puts are further away from the current stock price than the calls are, that means that there is more downside potential than there is upside potential for each of those stocks. Okay. What we need is for the stocks to go up to right at or just under the strike price of our covered calls. That's ideal. Then we get to keep the full premium from the covered calls, but we also get the maximum gains from the stock that we sold them on. What that could mean, now at that point, they could either roll their put up closer and protect the gains that we've had in that stock, or they can leave it where it is, which means now there's an even bigger dip that could happen before those protective puts help out. Now, I've talked before about whether or not the protective puts are a good idea. They seem like it on the surface. I did like them at first, but lately I've been wondering if they cost too much. And so they eat into the distribution, which eats into the overall total return of the fund. But that's for a mathematician to figure out. I haven't done enough math on the fund to figure it out. I would have to have probably several weeks, if not months, of data on each of their individual trades with the total dollar amounts and everything, and sit down and spend quite a lot of time to figure it out. So if you see that somebody else out there has compiled this information on how much the stocks moved up, how much they moved down, how much we made on the puts versus how much the puts cost, I would really like to see it actually, and then talk about it. But I just wanted to get on here and explain for everybody that still has any question about it, what moves ULTY's stock price. It is not people out there pumping this. There could be a million YouTubers talking about ULTY, and everybody that watches their videos could buy ULTY. And the only mechanic that would cause it to go up greatly in value from that mass amount of money would be that the underlying stocks went up because so much of them were purchased by ULTY. You can't directly affect ULTY's price significantly. Now, I have mentioned that in after hours markets, which are smaller pools of shares, and they aren't being bought and sold directly from ULTY, but they're being bought and sold directly from other investors who are participating in the after hours markets, that price can vary wildly. Okay, and we saw that happen with Robinhood, and it went down to like $4.59 overnight when the margin requirements got changed for ULTY, and Robinhood forced the sale of a bunch of shares of ULTY in people's accounts, or at least that's what I understand to be the case. Maybe somebody else could correct me if I'm wrong. So anyway, if you guys have anything to correct me on with how the open-end ETF works, go ahead and put it down in the comments down below. If you think that I'm wrong, put it in the comments down below, or better yet, do a Google search and figure out how open-end ETFs work if you don't believe what I'm saying, which you probably shouldn't, because you shouldn't trust anybody on YouTube. So go double check, but at least hopefully I've steered you in the right direction so that you can go and figure it out on your own. And I'll tell you what, guys, here's the deal. I'm on the road, so I tried to buy these olives, for a little snack action. I'm really kind of butthurt because I got them home and I didn't realize they still had the pit in them. I can't even put a toothpick through them and stick them in my cheap vodka martini. All right, so I'm kind of bitter about my pitted olives, D-gens. I'll talk to you later.